Hello and welcome to the Monday Futures Market Outlook for October 18th, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles a market has gone through. About a year ago, we crossed bullishly above that 80-week moving average, and during the entire summer consolidation, actually very positively held above that 80-week moving average. At this juncture, the likelihood is increasing that we are going to have a continuation to the upside that may even last a year or more as we come and test even as high as 1300 to 1350. The only way that we would consider a new bearish scenario would be if there would be very dramatic selling, something that would be well over 100 S&P points on the downside, breaking below that 80-week moving average for us to consider any bearish scenarios. But really, at this stage, any 5% market pullback will probably just emerge as a buying opportunity for another push higher. When we take a closer look at that S&P 500 using that E-mini futures contract, recognize that we've had a prolonged almost 6-7 week rally on the upside without any major market profit taking cycle. We've now hit our head on the overhead resistance at this 1170, 1180 area, but really there is another the year highs come in around that 1200 to 1220. It certainly cannot we cannot rule out the possibility that the market is going to gun for those previous highs here if it's given any motivation. But at some juncture, whether it happens off this current 1170, 1180 area, or whether or not the market first makes another push, maybe another 30 or so S&P points higher, at some stage we're going to get a market profit taking cycle. More than likely it would be about 5% in size, so we'll be looking for anything around 50 to 60 S&P point pullback, but that will only emerge as a buying opportunity going higher. So we're just going to be watching for signals of where and when that would begin. So just to summarize the key points, after 3 years of maintaining a bearish bias, we're changing our thesis to intermediate bullish. And in spite of being intermediate bullish, we want to emphasize that on the daily charts, we have completed and exceeded all our measured moves on the upside. So while the market remains positive and we are looking at it in a new light, recognize that a profit-taking cycle could naturally happen off of these levels. So the bulls, what we want to see is that the bulls defend the support lines during these profit-taking cycles. And if that happens, then we want to recognize that investors should cautiously commit money to the market during these consolidation points and during the pullbacks to really get yourself fully invested in the market. Next year, I want to take a look at the NASDAQ, and when we look at the daily charts on the NASDAQ futures, we can see that we have actually broken those year highs, which we marked off here as the 2030, 2050 area. We're now tested already in the 2100 area that we're currently at. There's some slight overhead resistance and some targets up in the 2120, 2130 area, but really the measured moves all indicate a number of upside targets around the 2160 to 2200 on the upside. So the fact that the NASDAQ is broken to higher highs has already opened the window for even continuation to some of those upside targets. Recognize even if we have short-term pullbacks, so long as they're contained in this, let's say 1960 to 2050 area during any profit-taking cycle, really at that stage it would just probably emerge as a buying opportunity, and we can continue to target those upside targets. Next year, I want to take a look at the US dollar index futures, and we continue to see a few stalling formations occur at the downside, two reversal candles on the downside around that 77, 78 zone. It's now giving us an indication that the US dollar is at least on the short term reached some sort of a tradable low. That does not mean that we can't see a consolidation here up towards 78, 79, and then immediate reversal that starts selling aggressively again. There's no indication that we've seen a major low, but the way the U.S. dollar plays out will play a critical role. If we see, let's say, the U.S. dollar spend a week just consolidating sideways here with no momentum gain, then that could actually be the grounds under which gold and oil make significant new pushes higher. So we're going to be watching the degree of which this U.S. dollar bounce occurs, because if there's no strength in the U.S. dollar bounce, it will continue to drive commodities higher. Next year, I want to take a look at gold futures, and now we hit some sort of a short-term high up around the 1380, 1390 area, and just as that U.S. dollar is bouncing, we're also seeing gold selling. So what we're watching for here is that where and how low will gold consolidate during one of these U.S. dollar consolidation points. But recognize that if gold, let's say, goes down towards the 1330, 1340 area, but dollar reverses and starts selling again on the downside and see continuation down towards 74, at that stage gold could theoretically break to 1420, even as high as 1450 or higher on the bullion prices. So as goes the dollar, will probably go gold bullion. So we're going to be watching whether or not the dollar can actually make a much bigger picture reversal here or not, which could see a correction in gold if it was to be the case. Next year, I want to look at crude oil, and crude oil here has certainly been consolidating up around the previous highs, around this 82 to 84 zone. What we were watching for here is as well the dollar correlation. So long as during this dollar consolidation oil's contained to, let's say, the 77 to 80 area on the downside, then it would actually still be bullish on a reversal higher and still could be targeting those 86, 87 zones for the year high for an upside target. So again, we're just going to be watching how far that dollar index goes. Next year, I want to look at the 10-year Treasury notes. At this juncture, we completed a little short-term measured move higher up to around this 128 area, and subsequently have seen a few of these reversal candles coming back down to these support lines. This is also a crucial moment. Really, at this stage, there's a lot of divergences in the 10-year and the 30-year Treasury notes, indicating a loss of momentum. And really, what we want to see is if the bulls can reverse and hold support lines here and try to drive this market higher up toward that 129, 130 area where some of the measured moves on the upside are. If we see in any way some bigger picture 10-year selling in the 10-year Treasury note, especially if it gets back down to that 124, 123 area on the downside, that would be the first indication in a long time that we may have a topping formation developing on these 10-year Treasury notes. Again, there's no official indication that has begun, but if we saw very aggressive selling at any stage here, that would definitely send some significant warning signs. The only way the bulls can keep this going, hold this 126, maybe even then down to 125 area where the lows came in a couple weeks ago. If those 126, 125 levels hold and the bulls can reverse and get it back above that 128 area, then we can target again 129, 130 for a finished move on the upside. But we want to definitely see them defend these support lines. That was your Monday Futures Market Outlook. Thank you for joining me.